Chapter 11, Section 2, Bonds and Other Financial Assets. So in the second section of this chapter, we are talking about bonds here today. By the end, we'll understand what bonds are, how they're sold, why they're necessary, and why they are a risk. So why are bonds bought and sold? So the whole idea first of a bond came about during war bonds introduced in 1942. This whole idea was a way to help fund World War II and make sure we had enough supplies and different amounts of needs there. So what could take place was the Treasury Department would put out a whole bunch of bonds. So let's say they were in need of $1 million. What they could do is put $1 million worth of war bonds out there, and then people could purchase these. It was considered very patriotic during that time to buy war bonds. You had elementary students gathering their money together to buy war bonds. Families were doing it. So it was a big deal trying to be able to fund the effort during World War II. And basically what a bond is, it's nothing more than a government IOU, a promise of repaying you what you purchased plus with interest. And here's a video that was shot during this time that was to really help promote war bonds.
Merry Christmas, Jenny. Mother, where are our stockings? Children, come and sit down a minute. Jenny, this is for you. And Billy, this is for you. It's Mother's Christmas present. War bonds. Yes, darling, war bonds. Oh, gee, thanks a lot, Mom, but I wanted a bicycle. I know you did, Jenny. And I know that Billy wanted a railroad. And I feel that you're both old enough to realize that your country is at war and to be willing to make sacrifices for it. Just think, if Daddy were wounded, one single war stamp might pay for the medicine that would save him from pain, even save his life. Oh, couldn't I have a bond and a bicycle? Yes, Ginny, you could. We could afford that. But if everybody bought everything they wanted, it would take thousands of people to make the goods and to sell them. And those people I needed to make essential things for the war. Don't you see? Maybe next year? Maybe, Billy. I know that's one thing your father is fighting for, so that we can celebrate future Christmases in peace. And that will mean that he'll be with us again. You'd like that, wouldn't you? Oh, yeah.
So in this video commercial, it was really there to help promote war bonds. So the whole idea was to sacrifice so that normal consumer goods could be purchased to fund the war. So that's what a war bond is. So there are different parts or different components to a bond that you need to understand. There's a coupon rate, a maturity, and a par value. So if you're about to purchase a bond, these are things you look at. First is the interest rate. What type of return are you going to get as the bond holder? The next is maturity. How long is it going to take until you see this return? And then par value is nothing more than the principal. So if you bought $100 worth of bonds, that would be the par value. That would be considered the principal. So let's look at an example here. So for this example, let's say that this company called Jeans Company was looking to raise money quickly. So they offered some bond options. And the bonds they were selling for $1,000 each. The maturity was 10 years and the coupon rate was 5%. So the issuer of the bond is the company, is known as the seller of the bond. The person that purchases it is the holder, which is the person buying the bond. So it would take par value is $1,000 of what they used to purchase, 10 years before they'd see the return, and they would have a rate of 5%. Now, during that time, as this money accumulates, the annual rate of return is known as the yield. Now, this is the amount that it's coming back in. So, if we continue on with this explanation, this example from the previous slide, we have our coupon rate of 5%, maturity 10 years, and par value of $1,000. So that means that we're bringing in $50 each year in interest. So that yield to maturity, the amount of time from the day you purchase to the end of the 10 years, is known as YTM, which is yield to maturity. And so the yield to maturity on this type of bond would be $500. So then the maturity value, you would add the par value plus the yield would be $1,500. So the yield per year would end up being $50. So that yield to maturity is very important to individuals when it comes to investing to see if it's worth putting their money and purchasing those bonds. All right, so let's look at an example here. What takes place if you buy, let's say, this $1,000 bond, but you don't see a return until 10 years and you're at 5%? And let's say for this example we have Sharon and Nate. Sharon has purchased this bond in hopes of getting a decent return. Her plan is to hold it until maturity. But something happens to her vehicle and now she's in desperate need for cash in order to fix her vehicle. So what she can do is go to the open market and sell her bond off. The problem is, from the date that Sharon has purchased this bond to today, the interest rate has gone up 1%. So as of right now, the bond has a par value of, if you were to buy a new bond today, it would be $1,000 at 10 years at 6%. So there's no way that Sharon would be able to sell her bond for $1,000 at 10 years at 5%. So what she needs to do is something called discount from par. And what that means is that she would have to give a discount on the par value. So she couldn't sell it for $1,000. She would probably have to sell it for $900. And then whoever buys this discount from par will then get a discount plus the interest that it gains. So she's at a loss. She's out of $100 for going this route. But she's in desperate need of fixing her vehicle. So she's left with no choice with that one. Now, bonds have different ratings. There is a couple of different websites that provide this information. One is Standard & Poor's and the other is Moody's. And if you were to go there today, you would be able to look up governments, you'd be able to look up private companies, and you'd be able to find out their ratings. Now, the highest rating that is given to a company is a AAA grade rating. And what that means is they are the most safest bet that you could possibly find. So, with a safer bet, a better chance of getting your money back, the higher the rate, the lower the interest rate. What that means is the lower the risk, the lower the interest rate. The higher the risk, the higher the interest rate. So if you're looking to buy a bond and you look at a company as a AAA rating, it's always known for paying back, they'd maybe give you 5%. But if you decide to go with a triple B rating company, now they're not as reliable or secure. So what you would need to do, what that triple B company would have to do is increase their interest rate, so 7.5%. So bigger risk, higher interest rate, lower risk, lower interest rate. And we're going to watch a video on this next one that explains what took place in the U.S. Not that long ago.
A worrying finish to an already dismal week for the global economy. The Standard & Poor's rating agency says it's downgraded U.S. Treasury bonds, traditionally viewed as a gold standard for investors. Some economists have suggested the downgrade will raise borrowing costs for the U.S. government, and that could mean higher everyday interest rates for Americans already struggling to pay off mortgages and car loans. Others say those fears are overstated.
The amazing part of the story is the debt is denominated in dollars. The U.S. prints dollars. How can we not be able to pay off our debt?
Still, it will add to the atmosphere of uncertainty surrounding the U.S. economy. Thursday was the worst day for Wall Street since the global recession of 2008. Friday was characterized by further ups and downs, with investors not knowing whether to buy or sell. Some traders say a slight increase in job numbers for the month of July helped buoy markets at the opening. And reports that the European Central Bank would buy up Italian and Spanish bonds in exchange for faster financial reforms may have calmed fears about the European debt crisis.
Alright, so what we took place in this video, this actually happened in 2011. The U.S. was taking on so much debt that we became a larger risk. So Standard & Poor's lowered our rating. So the U.S. is no longer a AAA rating, which used to be the best out of any country on the planet. We are now a AA rating. And as a result of that, now, as we talked about in the slide previous to this, if it's a higher risk, you have to offer a higher interest rate. So companies and individuals and countries that buy our bonds, as a result of that, now we have to offer a higher interest rate, which now means that it's going to be, which will increase the amount of debt the U.S. has now, because more interest has to return to the person, the bondholder. All right, so what are some advantages and disadvantages of being the issuer or the company that gives out the bonds? Well, the first advantage is the coupon rate is fixed and you do not have to share profits with bondholders. So you can really budget out how much exactly in your budget, how much needs to be returned to those who own the bonds. And if you have an amazing quarter or amazing year, any profits you bring in does not go to bondholders. They are just having a loan that you've given out for your company. Now, on the flip side of that, disadvantage, well, it's a fixed interest. So if inflation goes up too high, that company is still responsible to pay back that interest. So they could actually be losing more money. Or also failing to pay bonds back result in lower bond rating. So there is risk involved when it comes to this. Advantages, obviously, if they want to expand or the government is in need of funds quickly, but the disadvantage is it's not going to fluctuate with the economy, and if they don't pay back in time, their bond rating is going to go lower. All right, so let's quickly go through a couple of different types of bonds. Savings bonds. This is probably one of the most secure, safest investments you could do. Very little risk because the government is not going to go out of business. So savings bonds, sometimes maybe even your grandparents have purchased you savings bonds and they said hold on to it, they'll cash it in one day. They did that because there's nearly no risk. And the purpose of it is to fund public works. So if we wanted to build a brand new national highway system, we would offer a whole bunch of bonds in order to get the money for this in order to fund the project. Savings bonds are a little bit different. You actually buy them for a cheaper price and then you hold them maturity. So a savings bond of $50 you actually buy for $25, and then after it has matured it then returns to $50. It's just a different way of the government issuing bonds. So it's used for public works, roads, buildings, very large manufacturing, airports, things like that. And these are backed up by the Constitution, Article 4, Section 1, full faith and credit clause. What other bonds are there? T-bonds, T-notes, and T-bills. The difference between those three is just the timing. Treasury bond you hold for 30 years, a note 2 to 10 years, and a T-bill is a year or less. Now, another motivating factor for people to buy into bonds, the government instituted something called an inflated index bond. And what that means is, let's say you lock in at 5% interest for the next 30 years on this treasury bond. Well, that's a big risk because if inflation goes up, your return is not going to be going very well. You may be actually losing money on your bond. So let's say that you lock in at 5% and inflation today is at 3%. So that means you're getting a 2% return. Now, what happens if the amount of inflation goes up to 4%? Well, now that means you're only getting a 1% return instead of 2. So what an inflated index bond does, it means it'll fluctuate as inflation goes up or down. So if you're at 5% and today inflation is 3%, if it bumps up to 4%, well, now your interest rate will increase by 6%. So there's always that 2% profit that is included in there. If it drops lower to 1%, well, then it would also drop as well, your interest return. So inflated index bond. Other types of bond. So savings bond was on the federal level. Municipal bond is more on a local level. So it's by states or local governments or to finance public projects. So these are safe investments as well, and these are tax exempt. So if your city puts in a new library, public school, park, highway system, maybe instead of raising taxes, they offer bonds. So when that new sports complex went into Woodbury, I'm sure there was bonds that were offered for this that people could buy into. So by doing this, it's able to provide funding for a lot of different things. Now, that was federal and public bonds. Now we're looking at corporate bonds. Now, corporate bonds are more of a risk. Now, the question is, why is a corporate bond more of a risk than you'd find with a public bond? And the reason behind that is a couple things. First, the government has printing presses, so they could print the money, which would not be a smart decision to make, but they could do that. The second part that a public bond has versus a corporate is that they have a tax base. They have citizens that they can tax. A corporation does not have a tax base, so that's why they're more of a risk. If they go out of business, there's nothing there to back them up. So they are more of a risk, and income made on these bonds is also taxed. So there's a few things here. The next bond that we have is known as a junk bond, and these were quite popular in the 1980s and 90s. So these would be companies that would probably have a CCC rating or lower. So huge risk. A lot of third world countries were offering these on the international market that people could buy. Very high risk of not seeing your money again, but people are buying into it because they figured if they can get a few months into something, they would get a decent return. So maybe they say if the AAA rating is 3% here in the U.S., maybe you define a 12 to 18% rating on a junk bond in the Middle East somewhere. So there's a huge risk that was involved with this. A lot of people don't do these anymore just because there's such a huge risk. And as a result of that, they're not as popular. We're not going to really spend much time on this one. A CD is a certificate of deposit. We looked at this before in our notes. And a money market funds, we don't really need to do much more than that on that one. All right, last slide. So now we have the financial asset markets. So there's different types of markets here. We have a capital market, which means something that you hold on to for longer than a year. We have a money market, which is 1 year or less. So the best way to remember between the two is liquidity. And when we looked at a previous chapter, we talked about M1 and M2. M1 means money that is completely liquid. So any cash that you have on to you, you can do business right away because you don't have to go to the bank and get the funds that you need. So money market, 1 year or less, it can go quick. So there's kind of your tip there. If it's a 1 year or less money market, it can go fast. Capital market, this is your T-bonds, 30 years plus. Then we have a primary versus a secondary market. Primary market is selling financial assets that can be redeemed only by the original holder. So this is where you'd find savings accounts. You'd find certain types of bonds that are in here. CDs are in there. Usually you can't sell off a CD to someone else. So only redeemable by the original holder. So if I get a CD through Wells Fargo, only Wells Fargo then I could give it back to cash it in. Now a secondary market is different because I can resell that financial asset. So that bond that we talked about with Sharon and Nate, where Sharon needed money for her car, she could sell her bond on the secondary market. Stocks are the same thing. You can buy and sell as often as you want to, and you're able to resell those assets quickly. So this was Chapter 11, Section 2, talking about bonds.